Friday's Financial Fitness. During this pandemic that started over 10 months ago, I've had more clients ask if we should move their portfolio to cash than any other time in my career. I'm not sure if this is due to all of the uncertainty over the pandemic or the economy, or if people are simply getting nervous listening to the various stories in the news. Today, I want to share with you why it's important not to try to predict or time the stock market. Last week, the Dow Jones Industrials crossed over its magical 30,000 for the first time, and the Dow Jones Industrials had its best month in November since 1987. According to the Wall Street Journal, the Dow Jones Industrials were up 12% in the month of November, and the S&P 500 was up 11% in November. It appears the biggest reason for this run-up in the stock market is the U.S. is close to approving distribution of multiple vaccines for the coronavirus, and many economists believe the economy will be able to recover some of the lost activity over the next year. While it's difficult to predict how the economy will recover once the vaccination is widely available, I thought it would be important to look back where we've come from over the last 10 months during this pandemic and challenging times. According to Yahoo Finance, on January 1st of this year, the Dow Jones Industrials were at 28,638. Then on February 12th, the Dow peaked at 29,551. As word of the pandemic spread, actual cases started to enter the U.S., the Dow fell below 20,000 on March 8th to close at 19,898. And as things continued to worsen and more fear set in and we shut down the economy, the Dow hit the bottom on March 23rd, closing at 18,591, down 37% from its peak on February 12th. This was the fastest and deepest bear market in stock market history. The news headlines in America was across the entire country focused on the severity of the pandemic and its implication on different economies around the world and how they were going to minimize the impact of this pandemic. As we started to recover from the March 23rd lows, the focus shifted away from the pandemic and was now on the potential positive treatments for the coronavirus and the Federal Reserve's, quote, all-in, do whatever it takes policy, as well as the trillions of dollars the government passed in bills to support individuals and businesses in their various fiscal stimulus packages. So here I am today on Thursday, December 3rd, and the Dow Jones Industrials is at 30,040, up over 60% since its March 23rd bottom. Yes, that's 60% in less than 9 months. In fact, according to Bloomberg, if we look over the past 25 years, 7 of the best 30 trading days occurred during the 25-year period between March 24th and April 6th of this year, with the best day occurring on March 24th, the day after the market hit the bottom. Let me repeat that. 7 out of the 30 best trading days in the last 25 years occurred between March 2nd and April 6th of this year. So, what is the message I'm trying to convey? I think there's 2 messages I'm trying to convey. The first lesson that we learned is over the last 10 months, it's very difficult or nearly impossible to try to predict in the short run what the stock market will do. Even if you were able to determine in February to get out of the stock market, knowing when to get back in can even be more difficult. And second, don't bet against the Federal Reserve and the U.S. government. Despite the fact that the U.S. coronavirus cases are at record highs, the stock market continues to reach new highs also, as the Federal Reserve and the U.S. government have indicated they are all in and will do whatever it takes to support and grow our economy.